Hi, and thanks for loading up this short tutorial on pro insights on how to be a better investor. In this little tutorial, we'll chat a little bit about us, we'll talk about some common pitfalls in investing and some pro tips that I've discovered over the years, and the correct approach really to becoming a better investor. And really what you need to know will be a subject that we cover. And then finally, why do something with LTAG. I hope that you find this tutorial helpful. So let's get started with some introductions. My name's Albert. I founded LTAG earlier in 2023 on the request of some investor friends of mine whose portfolios really weren't doing very well, whereas mine had been consistently for the last 7 or 8 years beating the FTSE and the AIM index by quite some margin, principally because I use technical analysis and it helps me to time my entries and my exits. And when I want to hold a position, it helps me to stay sane when things are going crazy in the market, because I know exactly what the market makers or the shorters or anyone else that's playing the market is up to. So I put together LTAG and the courses, and we've had quite a few clients go through that. They've all done very well. You can see from the testimonials on the LTAG website that they really do rate these courses. I hope that you will too, but for the meantime, let's get some tips about how you could become a better investor yourself. So before we chat about pro tips, the most important thing to do is to actually look at common pitfalls, the ways in which you can go wrong. And here's a list on this page. The top of my list is you need to differentiate between trading and investing. Trading is when you are going in for very short time frames. You have a lot of data about what's going on at your disposal. You have plenty of screens. You have a lot of capacity to look at the information in the markets and are determined to do so. You're very disciplined and you know what you're doing. With investing, most people are investors rather than traders. And investors tend to pick stocks and they tend to hold them, and generally they hold them for too long. Traders will dip in and out. They often miss out on larger gains that investors have, because investors sometimes hold for the long term, and when something unexpected in the news comes up, they are the ones that benefit. The traders generally miss out on that. They make their 5 or 10% per day. The investors sometimes, but not always, make the multi-bags, as it's called, the multiple 100%. So trading is quite different to investing, and the psychology of a trader is very, very different to an investor. You need to know who you are. The next thing is that it's very dangerous to have tips. Tips, by which I mean tips on which shares to buy, what investments to have, at what price to get in and out. If someone is telling you that, particularly if they're telling you that on social media, be very, very wary. Tips sometimes work, but generally, if you trade simply on a tip and have no knowledge of the fundamentals or anything else, you'll end up not knowing what to do when something goes awry. So a tip can be useful in the same sense that, if someone that knows a lot about horses tells you who's going to win the Grand National, that'd be great. But it won't tell you about the horse's form. And in the same way with stocks and shares, it won't tell you about how a company is performing according to its fundamentals. It won't tell you anything about macro analysis, and it certainly won't tell you anything about what the market is doing at a technical level. The next thing on my little list is that we are all susceptible to incredible bias. The things that we like tend to be the things that we buy, and we tend to hold them for far, far too long because we think things will surely get better. So trading psychology is probably as important as knowing anything that's technical. And managing your psychology is particularly important. And one of the only ways in which you can do that is to have hard and fast rules based upon technical ratios that you do or don't meet, or technical trend levels that you do or don't breach. Managing your psychology is right up there in terms of the way to become a better investor. And of course, the best way of doing anything, a little bit like learning an instrument, is to practice. And the best way to practice is with dummy trades, not with real money. So if you know how to do that and you can place trades without actually putting money at risk, you'll be much the better off. So I would always advise, particularly as you're learning, to learn and practice, but not use real money. Use dummy trades, or indeed just see what happened in the past as if you had traded. You need to keep adequate statistics as to what you're doing. Oftentimes I see investment portfolios from various people where they just have no idea what they're doing. They don't know how much they have, what price they bought, at what price they want to sell. They have no targets, and so it's incredibly difficult to manage risk. So keeping a good record and keeping good statistics about what it is that you've done, that's really quite fundamental. With anything that's analytical, you can end up with way too much information, way too many tools, way too much complexity. One of the things that we teach at LTAG is to keep it simple. You'll be surprised that with maybe 20% of what you could know, you can make 95% of the gains that you could have. You really don't need the whole shebang. You need the right data, not lots of data. And that basically means that you shouldn't rely on bots or automated trading. Someone else has written those, not you, typically, unless you're very expert. And so it's a very dangerous game. And even if you have written them, they change because the market changes. You need to look at markets and be constantly aware of what is happening and why it's happening. And it's very difficult for it to be done programmatically unless you have a vast budget, as some of the hedge funds do. Now, one of the things also is you need to be able to combine all data sources. So data comes from fundamentals, what a company is doing, what its results are, what its upcoming news may or may not be. It comes from what's happening globally in terms of, are there any economic factors, are there any geopolitical factors, are there any wars, famines, etc. All of these have a significant impact on markets as a whole, and those markets will be driven by those macro events, and typically the large cap stocks will react to those first, and the small cap stocks will then follow. More often than not, small caps are sold so that people can hold large caps, particularly in funds. So you tend to get distribution of funds to some extent, depending on, with regards to what's happening in the macro environment. So keep a watch out for both fundamentals, macro analysis, and merge that with technical analysis. It's always best to have as much information as you can get hold of, not necessarily use it all, but certainly be aware of it. And the overall market sentiment is something which is right up there in terms of analytical factors that you need to be aware of. If we're in a bull trend, or if we're in a bear trend, it will be very, very evident from what's happening, for example, in the United States on the S&P and on the Nasdaq in particular. Those lead the world. 50% of all trades are in the United States, and it's always useful to keep an eye on what's happening in markets as a whole. And if you don't have any particular strategies and you're just investing randomly, you will inevitably end up with random results. The best way to invest is to have a strategy that you want to follow. You may decide to go into a particular sector or a particular type of asset type, be it currencies or stocks or anything else, and you become more expert in that, and your strategy should be something which you predefine, and it should enable you to go in and out much more accurately and on a more predetermined basis. Again, what you're trying to do is manage your psychology. And finally, with regards to having a strategy, that will help you to have risk management rules which you put into place, because if you're outside of your strategy bounds, outside of your mandate, your personal mandate, then you should be exiting or if you're being able to enter your mandate because it's breached the level at which you can buy, then again it helps you to buy at predetermined levels. So all of these things are things to watch out for, and oftentimes we find that really, albeit many people know some of these things, the practice is what is lacking. So if you're going to manage risk, it's of fundamental importance to know your entry points and your exit points, and you need to know those accurately, and that's where technical analysis can help you. You can be much more accurate with regards to the levels at which you want to enter and exit, and since the market is so volatile, having those levels set correctly and accurately is of prime importance. The market does move in cycles. People could become positive, they become negative, and that oscillates, and that has always been the case. There are plenty of theories as to how the market oscillates, and one of the key ones was started off with Dow, then it became Wyckoff, then it became Elliott, and more lately there's a gentleman called Hurst. Anyway, lots of people have spoken about cycles. If you understand how cycles work, it helps you. It's one of the best ways of understanding what's going to happen next in terms of prices. A lot of technical analysis is focused on how do cycles move and how do statistics help you to determine where those cycles will change trend in an upwards or downwards direction. When you're doing technical analysis and any form of investment analysis, really, you want to have confirmation. You would never buy anything of value without having looked at its alternatives and whether or not one price that you're thinking of paying is confirmed by various other sellers of the same product, and so that you end up with the best possible purchase at the best possible price. The same thing in stock markets. In technical analysis, you have various forms of indicators which tell you what has happened to price and volume in the past, and they show it in slightly different ways, and they have different categories of indicators in technical analysis. When those confirm with each other, you have a much stronger signal than if you only take one signal. So the whole principle of confirmation is one of the cornerstones of analysis. Similarly, if signals don't confirm with each other and indeed go in opposite directions, which is called divergence, that's a generally significant warning signal. And so analysts are always looking for divergence. The key to managing risk is to take your profit at predetermined ratios. Typically, particularly day traders, they'll have a ratio of perhaps risk reward of 1 to 4. They risk £1 and hope to gain 4. If they gain 4, they'll sell or buy, one way or the other, depending if they're long or short. But they have predetermined risk reward ratios. The trading system that you should have, particularly with regards to the ratios that you have, the levels that you want to set, the strategy that you've determined in terms of sectors, which we talked about earlier, that's really, really important to have a trading system. And your asset allocation across stocks is of fundamental importance as well. Are you going to choose to be very heavily invested in only one position? And if so, and many people are in a single position or maybe a handful of positions, a little bit like Warren Buffett. And if you are, that's fine too, but be aware of why you're doing it. And when the market oscillates, as it will inevitably, as people move through cycles of hope and despair, and that tends to be the market, then be aware of why it is that the market is moving that way, so that you don't sell at the wrong time or buy at the wrong time. The principle of not over trading is really, really important. I see so many people doubling down or buying more so that the average price can be reduced if something has dropped in price. The most important thing is that if you have made some losses, just have some rules. Back to risk management. If you've lost 2 or 3 times, that'll be it for the day. Wait until you have a clearer head the next day. Be aware, of course, that the market moves intraday in its own cycles, and so traders generally come in first thing in the morning. They'll take long or short positions, and then they'll sell their positions later in the day, particularly if they've gone short and they don't want to carry any form of margin overnight. And that brings me to the importance of knowing various diary dates. There are dates throughout the month and throughout each quarter and at the beginning and end of each year, which are important. Interest rate settings at central banks is something obvious, but also when hedge funds have to liquidate or settle their books on a quarterly basis, those are important dates. There are various tomes that you can buy which show you what all those dates are. And don't forget that markets are only on an uptrend 20% of the time. 80% of the time they're sideways or downwards. That's important to know because so many people wonder what's going on, why is it going sideways for so long? That's absolutely normal. So, pro tips and pitfalls out of the way. What's the right approach? Well, the right approach, and you would expect us to say this, is to have the right content from the right people delivered in an easy to understand fashion. So that's us, that's LTAG. We have done this, and you can look at the testimonials on our website, which show you people who have gone through our courses and who will confirm that it is an easy set of material to understand if you've got the right tuition. And simplicity, I have to stress, is so important. I said earlier on that there are hundreds and hundreds of potential indicators and potential ways to analyze the stock market, all of which have various forms of merit. But the important point is to have a handful that you know over time are reliable and work and get you 95% of the returns that you could have. That last 5%, which might take you 95% of the time to reach, if ever, really isn't worth it in our experience. Better to have tools that work, simple tools, easily comprehensible tools that confirm each other, that if there's divergence you can see easily. The important point is, as I said earlier on, to practice. Start small if you can. If you're already significantly exposed, then anything that's new, again, practice small on the new stuff and develop your skills over time. Having been an investor for many years, I've come to realize what's important and the order in which really you should learn things. You can see here on the graphic, and you can pause the video any time so that you can read it more carefully, that really there are a number of things that you should know, and it breaks down into things which are relatively basic, which are intermediate, and which are more advanced. At the basic level, it's more to do with how does price move and how does volume affect prices. The interplay of price of assets and the amount of assets bought or sold, which is volume, is one of the fundamental determinants of technical analysis, investment analysis. It's called price action, and many people use only that, and that's perfectly feasible. And if that was your only tool set, that would still be a material step upwards. And you need to have a trading platform on which you're going to practice, and you need to understand how markets move at a basic level. We call that market theory basics. But once you have all of that, then you can start building on some of the more analytical tools, indicators they're called, of which there are, as I've mentioned earlier, hundreds and hundreds and hundreds, and more are being developed every single day. You can't possibly know them or use them. And sometimes I've seen chartists of various types who have so many indicators on their chart you virtually can't see the chart. There's so many indicators. That's a completely impractical way of doing any form of analysis. So what we do is we look at which indicators work. Out of the hundreds, we've pre-selected around 20, which we think are more than enough for you to make significant profits. And we look at how those interact with each other, how they would confirm with each other, and if they were going to diverge, how those divergences would be seen. That's really that gets you to an intermediate level, and then past that point, you need to understand more about how the market operates, and in particular how cycles operate and how statistics. And there's a particular set of statistics called Fibonacci ratios, which almost all the algorithms that hedge funds write use. And if you know what those statistics are, the key ratios that algorithms will be written to, you can at least know when it's likely that things will reverse in one way or another. And as I say, the market does oscillate in terms of positivity and negativity constantly. And then with all of that in hand, we spoke about risk and managing your portfolio, managing trades. All of that needs to come to the fore, and you need to be able to test your ideas in a much more succinct way using various trading capacities that the platforms have, which enable you to model what would happen if you did ABC. It's called forecasting or strategizing, which you can do and do quite easily yourself. So those things help, and it helps you to put into place risk management strategies of your own. And then finally, there are some quite complicated ways of looking at charts and patterns on those charts, which use a combination of statistics, cyclical analysis, and that's the final way to look at something. Many people don't use that, but it's useful just to be aware, because many of the various authors on social platforms do use those. So if they come up with it, at least you know what they're talking about. So why would you take on board any tuition from LTAG? Well, the main thing I would say is that we are very experienced. We put together a course which is very well structured, very well reviewed by the people who have taken it to date. You can look at the reviews on our website for that. And the thing I would point out is that the strength is the clarity and the simplicity of what we put forward. It can be very, very complicated to look at financial markets. We take that complexity away for you, and we'll just show you how to do things in a way which is simple, comprehensible, within an acceptable amount of time for you, and will work quickly. By comparison to many other sites, which you could be doing a technical analysis course for many months, many years, you could be looking at YouTube videos from various people, none of which will be comprehensive, because they'll just show you one particular facet and not tell you how it integrates with everything else. So we're structured, we're comprehensive, we're simple, and we'll get you there quickly. So I hope you found that useful, and there's been some nuggets in there for you in terms of potential pitfalls, potential pro tips for you, particularly trading psychology. I think that's so important, as well as the various ways of keeping things simple and comprehensive at the same time. Look at our website, ltag.uk, and you'll find that there's a variety of ways in which you can do your tuition with us. You can do it as various courses in terms of basic, intermediate or advanced courses, as you saw on the schematic earlier, or you can even do it for a subscription service. There's more details of that on the website. Or depending upon your existing level of knowledge, you may prefer to top that knowledge up with some specialist one-on-one training, so that you can maximize whatever it is that you're trying to do at this time. Whichever way you look at it, we've got various ways of delivering a service to you which will, we hope, make you a better investor. Certainly our existing clients would say that they have become better investors. We look forward to seeing you on one of our courses, and thank you for your attention. It's been a little bit long, this particular presentation tutorial, but I hope that you found it worthwhile. Thanks very much, and see you soon.